leveraging your time and putting a priority on your time more so than your money in terms of professional goals. And that, I think ultimately is kind of what drove me down to the pursuit of real estate.
Hello, ladies and gentlemen. Welcome back to Commercial Real Estate Secrets. I'm your host, Austin Hare. Our guest is Neil Wahlgren. He's the COO of MAG Capital Partners, where they focus on industrial manufacturing real estate investments, and they currently have $300 million under asset management spread over 45 properties. And Neil, pleasure to have you on the show today, my friend. How's it going?
It's going great. Thanks for having me, Austin.
Yeah. So, all right. You got a little bit of an interesting story here. And so, I always like to give a little bit of a background just so people can kind of wrap their head around, what different paths or life choices led you to real estate or to where you're at now. And so I know in your case, you started, was it out of high school that you went into the Air Force, or how did that happen?
Yeah, so I did undergrad right after high school at the Air Force Academy, which is a bit of a lead-in for the officer track, which is kind of the way you need to go if you want to ultimately end up being a pilot in the military.
That's cool. And so obviously you don't need to have your pilot's license to be a realtor. So what inspired you to go that route? Like, were there like recruiters that in high school that you talked to, or what exactly happened there?
Yeah, I grew up kind of in the East Bay, which is about an hour east of San Francisco. Kind of in the suburbs out there. It's, very stable, consistent type of neighborhood. But I think, 17, 18-year-old Neil was ready for something a little different and more exciting. So that was really the drive on, getting out of town, doing something, outside the ordinary there. And, ultimately what led me down the pilot track there. But, it does come in handy when it comes to, getting an aerial site visit, if you will, on some of the properties. And
so do you actually fly? Do you actually fly now to check out different properties?
Sometimes I do, yeah. Yeah, when they're close by, I'm qualified on a little 4-seater Cessna to take out, and sometimes investors or other business partners.
That'll be a way to win over some business.
Yeah, exactly, right.
So, in the Air Force and in pilot school, how do you, what kind of lessons did you learn? How do you think that set you up to go into real estate investing?
Yeah, I've always said, good investing as an individual and as a team, I think is about consistency and repeatability. And each time you do it, you should get a little better. But the only way you can consistently up your game is by, really setting up a series of processes. And, everyone's very different in how they do it. But, I was able to take a lot of the experience that we used, in flying planes, really very methodical checklist discipline, and really bring that to, the approach that we take for evaluating new deals, for getting them under contract, ultimately, getting them all down the steps for securing debt, securing equity, ultimately closing, and seeing them through full cycle, being able to see a lot of that standardization and consistency methodology from the pilot world and bring that over.
And were you always kind of like a systems and procedures guy, or did the military kind of hammer that into you? Or I guess Air Force, I should say.
I guess, you could probably ask my brothers and they'd say I was a little OCD in high school. But no, I think in general, I think when it comes down to, kind of the tactical level, the nitty gritty of what you're focusing on for work or for your, hobbies or whatnot, I've always been very detail oriented and kind of structured on that side.
And did you keep the habits with you? I think, they make you work out a lot and they make you wake up at 5 in the morning. Did any of those habits stick with you?
I wake up at 6 now, so, getting a little sloppy in my old age. Yeah, but no, I work out in the morning. A lot of those habits, they work for a reason, and, your day gets busy, life gets busy as it goes on. So that morning hour is your sweet spot for really focusing on yourself, I found.
Yeah, I agree. You can get a lot done during that time. Or even if you don't get a lot done, you can just at least get your headspace right.
Exactly. Yeah. There's nothing more clear than, doing internal brainstorming when you're, in minute 30 or 40 of your run, just working hard and sweating it all out, right?
Mm-hmm. Okay, so how did you transition from Air Force into real estate?
Yeah, so I hit a point where I kind of realized military flying, that chapter was kind of coming to an end. If you stay in the military long enough, you kind of transition more to an administrative, leadership role and less flying. And that was, kind of a pivot point for me. Most guys in my shoes there end up really going the natural, the natural next step is flying for the airlines. So they go, fly for United, Delta, American, et cetera. And I kind of looked at that and realized, it's not a bad job, but it just didn't really excite me, I guess. It's a very just kind of structured. I mean, really, it's based on seniority, right? Where there's no real way to leverage yourself and your time besides just waiting, right? And, ultimately you fly a little less, you make a little more, but it's based on just waiting for all the guys ahead of you on the totem pole to either retire or die or what.
Yeah, it's very linear.
Basically, very much, yeah. And so, that was kind of I decided this is not the track I want to do. And, in that process, someone had introduced me to Rich Dad, Poor Dad, read through that, really, got behind this idea of, leveraging your time and putting a priority on your time more so than your money in terms of professional goals. And that, I think ultimately is kind of what drove me down to the pursuit of real estate, to the pursuit of, owning equity in cash performing assets that work even when you're sleeping, that, generate cash flow, really to run your life in a way that you don't have to work if you don't want to. And that was an early goal of mine.
Yeah, it's funny. So this was when you were still in the military, or was it when you're coming out of it, or what?
Kind of right at the transition point, so about 10 years ago.
Yeah.
And, my first foray into the private sector, actually, I was all hyped on this, this equity idea and, stock options from California. Everyone's all about startups, this and that. So I did the natural thing and I joined a startup, but it was actually a renewable energy startup. So a little different than the tech stuff up in the Bay Area. This is down in Southern California. And worked with them for about 3 or 4 years. And it was a fun project. We had some early funders and kind of this unique technology of converting basically excess wood waste into the hydrocarbon-rich vapors that form gasoline. And then also this black carbon-like residual material that you could use, clean up, and turn into an a soil additive. And so I was on the ag side. And
wow.
So yeah, got to do that, and it was
fun. How did it work out?
The technology worked. The price point did not. So eventually, the business model kind of folded, and they ran out of funding, like a lot of startups do. But it was a great experience, and kind of really gave me an appetite for the private sector. And ultimately, the next step beyond that was actually flowing into a similar startup, but focused on real estate.
Okay, and what was that?
It was a small company ran by the husband of a family friend, and he had built this, kind of lean business model of being the equity arm and joining with commercial, basically developers and commercial brokers who had a really skilled outlook in putting together real estate projects, typically in a very focused area with a focused team. And maybe they were great at executing, but lacked the access to capital, especially investor capital. So we were effectively the investor arm for those partnerships. We would JV project by project, and ultimately got to see a lot of different asset types that way, a lot of different real estate types, real estate groups, sponsor teams. Really guys who are boots on the ground running these deals. And one of those groups we partnered with was Mag Capital. I love the model, I love the team, and had the chance to join up with them full time about 3 years ago.
And okay, so yeah, let's dissect this a little bit for anybody maybe who's
Sure.
like wanting to get into real estate. They don't know a whole lot about it, and so essentially your foot in the door was working with a guy who you said he partnered developers with brokers. Was that kind of like his value?
No, he would partner. He would partner with either developers or partner with brokers, basically guys who had a project but needed access to money. And so our business model at that prior startup was we had relationships with a large number of investors, and we would effectively secure the commitments, secure the fundraising capital to fund those real estate projects. So we were effectively the equity arm on a partnership to make the real estate deal a reality.
Okay. So yeah, I think, most people either have time or you have money, right? Or it's either going to cost you time or it's going to cost you money. And so a lot of times, you can take the time originating these deals but then you got to figure out how you're going to raise the money, and that comes through relationships. So, I mean, how did he go about building the relationships of people who were wealthy enough to fund these deals, or is that something that he brought you in to do?
Yeah, I mean, he had started, kind of at an early level. He had worked at a number of kind of tech startups and knew a lot of guys in the tech field that had money. And his original business model actually was focused on buying single-family investment homes out of state. And now there's a number of operators that kind of provide that product. But at the time, this is maybe 15, 20 years ago, there wasn't a lot of people doing it. And this idea that, hey, even though you live in, say, California, you love California, you love living here, this might not be the best place from an investment standpoint to buy real estate. And so he did a bunch of, basic analysis, landed on Texas, and said at the time, Dallas-Fort Worth, it was kind of on the early trajectory compared to what it is now.
Yeah.
He said, hey,
I mean,
this has great fundamentals.
He spotted that trend well.
Yeah, no, absolutely. And took a data-driven approach. And, a lot of guys, basically invested with him, and ultimately, he would basically be the product, originator for both an investment home. He'd do some rehab on it, secure it with a renter, and effectively, allow that investor to buy a fully occupied cash flowing rental home.
Yeah, and that makes sense too, because a lot of times I feel like there's these steps that you go through, like where it's first thing to do is start with a single family, like residential home, just because the banks will lend on those. It's easy to get access to capital on those, and then that kind of segues into multifamily, where maybe you're doing like a duplex or a quadplex, and then eventually that goes into commercial, where you would have 10 unit plus multifamilies, or it could be retail, which is what we focus in, or industrial warehousing, what you guys focus in. And so it sounds like he was kind of on that same path.
100%, yeah. And a lot of our investors do the same, where, they'll start buying a house down the street, get comfortable, maybe 2 or 3, maybe in a different area, and then eventually realize, hey, just owning single family it's hard to scale, right? Mm-hmm. And it's just a lot of work. And, there's a big difference in just overall workload of owning, say, 20 individual houses compared to, say, 2. And that's, without having a small team to manage all that, it's really hard to do on your own. And there's other ways you can kind of augment some of that single family ownership through the passive commercial structure. And really that's what our business model at that prior firm kind of evolved to. And we realized, the single family opportunities were kind of getting priced out a little bit. They were still lucrative, but not as lucrative as they used to be. And we were seeing more opportunity in the commercial real estate space. And that was, he brought me on, and really I helped transition the company over to a strictly passive commercial investment firm. And, ultimately that was a nice segue to grow the company in terms of, investor pool and really grow our opportunities too.
Yeah, because the only way that you can grow through scale in single family is by the number of properties you add. And the revenue or the rent or whatever you want to call it doesn't grow at the same rate as the price of the house does, right? So it's like you have a $100,000 house that could produce, say, $1,000 a month. If you have a $10 million house, it's not going to be producing $100,000 a month, right, in rent. Like, you know what I mean? So it doesn't scale up as fast. But that is not the case with commercial, where it's like it's all a factor of the income. So it's directly proportional to how much money you pay for the property, right? That's all based on the net operating income. And so, I think it's similar to a lot of people. And, if you do something that, like, you're fortunate enough to land in a place where you have a lot of expendable income or things that you can invest, like, some people can skip over the whole single family residential stage, but I wasn't one of those guys. I started through there, and I had to work my way up a little bit. But yeah, it's nice because now with commercial, I mean, like you said, they're single tenant, triple net leases. Like, for the most part, they're taking care of a lot of the stuff, and it's just not only are you scaling per property, but you're also doing a lot less headache because their business is on the line. And they're responsible for making a lot of the maintenance and the upkeep or whatever, and they might send you a bill depending on your lease, but it's not taking up your time and attention like it does with a lot of the single family.
That's 100% correct, and really. Our experience is the more substantial the tenant, the deeper that tenant credit is. And as you go into the commercial space, and especially the larger commercial manufacturing space, you end up with really, strong professionally run companies that are your tenants, and they pay rent on time. They don't give you a lot of issues. They're much more contractually based as opposed to a lot of the, we'll call them personal factors that end up showing up in the single family investment world.
And so it sounds like your responsibility when you came on as partner was bringing in capital. Is that accurate?
Yeah. You talking at Mad Capital?
At Mad Capital, yeah.
Yeah, absolutely. So, we were looking, kind of at one of those critical points in a business's growth where, we realized, hey, we need to really invest in the growth and kind of nurturing of our investor network in order to, grow organically on what we're able to chase, what we're competitive at, and, the other elements of our business. So, I came on and really, started taking it from a super tight friends and family model into, a larger referrals, colleagues, outer friends.
And how long did you wait to do that? So did you do like a deal or two with your friends and family that you had something like kind of like a track record before you went outside your network?
Yeah, I was fortunate having been in this space, about 5 or 6 years. I had, more or less an industry track record. And then, some people I've worked with directly, but, a lot of it is repeatability, right? And, it's saying, hey, this isn't me just saying, I think we can do this, having X, Y, and Z in your track record that you've chased, you've bought, you've held, and you've sold. And luckily, as an investment group, we had that track record kind of early on in order to leverage into, in my opinion, more, I would say, faster growth because it was anchored with, real results, which ultimately, back up your assumptions that you're making on future deals.
Yeah, that's good. All right. So, and then walk us through a deal that you guys would do and like how, let's get into kind of like the weeds a little bit in terms of like,
sure.
How much is a purchase price? What's the value add? How do you split, equity between general partners and limited partners and stuff like that?
Yeah, absolutely. I love the industrial space because it's very non-correlated with a lot of other types of commercial in that, the biggest difference is, most other types, take office or retail or multifamily, you're looking at more of aggregate demographics where you typically have a lot of different tenants under one roof and you have property management and you're looking at a lot of shorter term leases and there's churn and, you're willing to expect some level of vacancy. You're typically investing some money to try to, increase occupancy and increase rents. And there's just a lot of moving parts. Industrial, on the other hand, is more of a defensive play. So we come in and, to answer your question, we're typically buying commercial real estate, commercial industrial through a mechanism called sale leaseback. So ultimately, it's a owner occupant. So imagine a manufacturing firm that also owns the building they operate out of. They sell us the real estate and simultaneously sign a brand new, long-term, typically 20-year triple net lease. And that triple net lease means they remain responsible for really all the expenses tied to real estate. So they pay their own taxes, they pay their own insurance, they pay their own utilities, all their building maintenance, et cetera, et cetera. So we are effectively taking ownership of a piece of real estate with a fully occupied tenant. It's cash flowing from day one, and the expenses have fully been removed, and all those expense responsibilities are on the tenant. Yeah,
and that makes a lot of sense because it's 100% safe, right? Like you've already gotten the tenant. The risk factor is largely taken out of it. I mean, I know nothing can be 100% guaranteed, but as close as you can get to that, like that's what you're arriving at when you do a sale leaseback. And so, how do you go about determining the price? Because it's kind of a little bit of a sticky situation when they own their real estate and they have incentive to lower the rent for themselves, but then they're lowering the sale price, and then they, if they increase their rent, then they actually are increasing the price that they could sell it for, which puts money in their pocket. And then you've also got the issue of the cap rate, right? I'm assuming most of the negotiation probably stems around the cap rate, which is like, how much am I going to pay for this income stream?
Yeah, and that's a great point. And so that cap rate ultimately drives what we call yield, and that yield is effectively the ratio of cash flow compared to the price. And what I love about a sale leaseback is we can set our target yield, and that target yield does not dictate a specific price that building has to sell for. And so what I mean, to use an example, right? I might have one seller for sale leaseback that's looking to maximize the proceeds from their sale. So I can set a target yield, and I can say, yep, I'll pay you maybe on the high end of the market's spectrum for your real estate, but correspondingly, you're going to sign a lease that leases it back at the high end of a rent price per square foot. Conversely, I might have a different seller who says, hey, I'm more interested in having a long-term cheap rent. And I can say, okay, we have our same yield target, so now I'm going to, for that new lease, I'm going to charge you a low price per square foot, but correspondingly, I want to buy that real estate at a low price as well. And so really it's kind of, in my opinion, it's more of a win-win from buyer and seller, and that you can kind of find, where that sweet spot is that works best for both parties, as opposed to a traditional transaction where you're just kind of battling it out over price. Whoever is going to pay more or less is a winner or loser. It's much more symbiotic in that respect.
And what's the yield that you're looking for? How do you guys calculate that? How do you guys determine what you want to look for?
There's a lot of factors. So that yield's tied to cap rate. In general, the higher the cap rate, the better yield. So we, as buyers, like any commercial real estate, we want to buy at a higher cap rate and sell at a lower one. Ultimately, we're finding better cap rates. In today's market, 2021, most decent industrials trading between high 6s and 7% cap rates. So, we kind of play in that space as well. We find, better yield, better cash flow that's risk adjusted in the Midwest than you will on the coastal markets. In addition, we look for, say, secondary cities as opposed to primary. Cities like, downtown Chicago or St. Louis or Dallas, those are going to drive a premium on the price of your real estate, thus driving down your yields, driving down cap rates, just based on where the location is. So we prefer, higher amount of cash flow, still risk adjusted with the right tenant, and we can find that, going to secondary cities, say like right outside Fort Worth, or say, Des Moines or Lincoln. All these are still Midwest markets, but maybe not, primary markets. But we're still able to find a nice balance of, relatively low risk with good cash flow, which is kind of that sweet spot that we seek for our investment types.
Yeah, a lot of times when you get too much into these primary markets, the value is largely based on the land and the potential versus what it's actually cash flowing. And so, some businesses just doesn't make sense to own the real estate downtown or wherever in these massive markets, because a lot of times there's something else, like, it's trading at the maximum potential for that value. So you may not have the best business suited in that location, right? Like if you have a dentist office in a downtown location, and they're asking a 5% capitalization rate for the real estate, it just doesn't make sense as a dentist, because that's going to bump up the rent and the taxes and all that kind of thing. But like somebody would benefit from that, like a Starbucks or a restaurant or something else, right? And so, yeah, I agree. Like depending on the space that you play in, it just doesn't make sense to target these primary markets, like these A-level markets that are super busy and super saturated. And so you can get more, like I would say, fair market value when you start to play outside of those markets and more of like the blue ocean than the red ocean.
Yeah. Well, and one thing too to look at, which I find, fascinating, and I feel like this effect has really magnified over the last 2 years since COVID, and that's really focusing on areas that you have a competitive advantage. And what we found is, primary markets, there's a lot of big institutional investment groups that, based on their charter, they will only look at, basically assets in A-class markets. So suddenly, you've tripled the amount of competition you have on a limited amount of assets in those primary markets, to the point where, you're getting even more compression than you would have had, because you're playing in that space that is an eligible pool for these bigger players. So by kind of looking for opportunity in the seams, that's where we're able to find more of a competitive advantage for the size of our team, our ability to move quickly, and, frankly, being able to seek out and evaluate opportunities a lot of other groups won't even look at.
And so when you're looking at purchasing, you said you play in the 7%, high 6s. Are you looking for value add right away? Like, are you looking for assets that trade at cap rates a little bit lower when you can purchase it, or is it mostly just for the cash flow?
Yeah, so I would say the standard sale leaseback has moderate value add that potentially can grow bigger. And so to expand on that a little bit, the moderate value adds created really threefold. You have, the first bit is going to be very predictable pay down of principal on the real estate debt. So it's all fixed rate debt. There's no IO. So every month you're paying down the loan. The second piece is a very, very predictable increase in net operating income, NOI. And so that NOI is
annual
driven,
bumps.
Yep. So there's annual bumps and there's no expense line, right? So normally the controlling your expenses is a mandatory thing that either is or is not successful. We've removed that operational piece. So as rent bumps kick in, that is directly correlated with increases in NOI, which drives value and equity in your project. And then the third piece is you actually create some modest value by being the architect of that sale leaseback. So by being the one who designs that lease and designs the structure, there's typically a small premium, and that's really derived because you are the first holder on that long lease term. So just to use an example, if you set up a 20-year lease, if we hold, say, for the first 5 years, we can still sell that asset after 5 years with 15 years left of term on that lease, which is still a huge premium. So because we are the very first holder, we're able to see some premium when it comes time to sell that potentially other buyers down the road would not see.
Yeah, so essentially you're signing the lease, you're working with a tenant who's probably growing in credit and EBITDA and profitability every single year. And so as time goes on, they're going to trade, their buildings that they rent are going to trade at higher multiples or more compressed cap rates. And not only that, but you're also probably going to see annual rent bumps, or at least you said hold it for 5 years. So you'll at least see one rent bump on that 5-year mark. So now you're getting the two added benefits. Number one is you're increasing the rent if you hold it for 5 years. And number two is now that tenant has more credit, which means it could command a lower cap rate. And so, and I'm guessing that at the 15-year mark, you're still getting the absolute best value. I would even venture so much as to say, as even if they have 10 years left on their lease, you're probably still going to get the best cap rate for those tenants, right?
Exactly. Yeah, in general, you get kind of premium cap rate pricing with anything over 10 years left of term on the lease.
So what are some reasons, like for these companies, what are their motivations to do sale leaseback? Because, obviously they're giving up, they would be on the receiving end of those benefits that we just mentioned. So why do they come to you, or how do you locate guys that are more likely to say yes to the option of a sale leaseback?
Yeah, it's a great question. The first thought a lot of people have is, thinking of a distressed seller, right? Oh my gosh, we need money. How do we get cash? We're going to sell our real estate, kind of a fire sale scenario. In reality, it's typically very different. What generally happens either concurrently or right before a company's sale leaseback does a sale leaseback is they're typically being acquired by a competitor or being acquired by a private equity group. So in the course of that acquisition, the buyer will typically pay with a combination of acquisition debt plus equity to buy that company. And what happens is they're usually laser focused on the operations of that company. When part of that company's assets that they paid for include real estate, quite often they will sell off the real estate through a sale leaseback in order to really trim down the cost of that acquisition, to pay down some of that debt they took on, really to reduce the overall cost of that acquisition by doing a sale leaseback. So
that makes sense.
It allows them to get more for their money from an acquisition side. So that's probably the main driver behind why companies would do that.
Yeah, and we see that a lot in the dental service organization space as well. And so now the thing that happens, though, is that when you go from a single operator to somebody who's acquired by either big private equity or a publicly traded company, their credit rating goes up, which means the value of their real estate goes up. So are they capitalizing on the increased value of that real estate when you buy it, or is that something that you try and buy before that new lease is signed, and then essentially you're getting the benefit of the value add?
Short answer, it depends. Really some deals will be just securitized from a credit perspective on the company that owns the real estate itself. Other ones, depending on if that credit is maybe weak or marginal, then we will require a secondary guarantee from the parent company. And that could be, an acquiring company, or if they have an overarching, corporate manufacturing group that owns, say, several manufacturing firms. We will seek out sometimes secondary guarantees in order to enhance the overall credit. And then to your point, the stronger your credit is, the lower that cap rate will drive down because your overall risk is driving down as well.
Yeah, and I guess my question is, how often are the guys selling their real estate for sale leaseback valuing it based on the fact that they've now increased the credit of them as the tenant?
Yeah, to be honest, that piece does not typically move the needle a whole lot unless they were very weak to begin with. So if that company, if the credit could stand on its own, having a stronger guarantor behind it, it might enhance the overall picture a little bit, but it's not going to swing the price significantly. Ultimately, that cap rate is what's going to drive the price, and that cap rate is more so set based on comps, based on similar lease terms, and based on really similar geographic warehouse industrial space.
Yeah, so the value is being the architect of that lease and signing a fresh 20-year lease, and then you get to participate in a lot of the benefits while the asset appreciates.
Yeah, the only time I would say the credit really affects the cap rate is in the reverse scenario, where if a company is kind of struggling, barely paying their fixed costs, then you're going to have kind of more of a distressed sale cap rate, and then you might see a cap rate in 9s or 10s because the buyer's clearly taking on a great amount of risk on a company that may or may not fail.
And how are you guys originating these deals?
Yeah, a lot of them comes from really just a very, very tight network of commercial brokers.
The price points are what? Like 100 million, 50 million?
I mean, you can find those. Most of what we play in are about 20 million, 15 to 25 is kind of our sweet spot total deal capitalization. And that might be one property or it might be a small portfolio, but typically all with the same tenant backing the lease. And then, coming in there, really most national real estate brokerage firms will have, maybe 3, 4, 5, maybe 10 at maximum sale leaseback brokers within their large pool of brokers. And those guys, they all know each other. They talk, they trade, they buy, and they sell from each other. And it's a relatively small group. And that's through that network. Both of our principals are both commercial real estate brokers by trade. And a lot of our deal flow comes from just relationships they've forged over decades at this point.
Yeah, because, the barrier to entry is pretty big when you're talking 20, 30, $50 million. So, not a whole lot of buyers in that area. But, all right. And so then, and that makes sense. And hopefully people are grasping the breakdown of that. But let's talk about like an actual, general partner, limited partner, investor split. Like how does that actually break down? What does that look like in terms of being an investor in one of these projects?
Yeah. So, it's going to change a little deal to deal. But ultimately, we strive. These are centered and structured around near-term cash flow. So, in general, I would say our day one cash flow from a cash-on-cash standpoint is going to range between about 7 and 9.5%, just depending on the deal. A lot of factors in that, and then typically you're going to see either annual or every other year increases in the preferred return. And that increase, those are going to be driven by built-in increases in the rent. So as that rent kicks up every year based on the lease terms, cash flow is increasing, and we pass it on to investors through a stair-step escalating pref model. So on average, I'd say the pref will increase between 25 and 50 basis points every year. So let's say you start at 8, might be 8.5, year 2, 9, 9.5, et cetera. And then we'll hold typically about 4 to 5 years. Our target's having, roughly 15 years left on the lease when we go to sell. And then at that point, we sell, we return investor capital, of course, and then everything left over, net proceeds, we'll do a GPLP split. In general, that's about an 80-20 split. But again, there's always, a little bit of variance from deal to deal.
Yeah. And so, are there any, like, do you need a property manager for these buildings or management fees or anything like that?
There's some light asset management, but no full on property management fees that you would see, say, in a multifamily project.
Okay. All right. So essentially, you invest. It's a 45-year project. You're getting an 8% return on that capital. That'll kind of increase each of those 4 or 5 years, and then whatever the proceeds are split 20% to the general partners, 80% to the LPs, which are the investors. And typically, I mean, what kind of percentage do you guys target in terms of ROI?
Yeah, and I'm always a little hesitant on talking about past performance.
Right, I know.
Caveat,
if your lawyer's
the industrial
listening,
markets have been
past
good.
performance does not indicate future performance. This is not financial advice. Blah blah blah. Yeah, right. Just theoretically.
But no, I would say this asset class is a little more consistent in terms of returns. You're going to have less out of the parks, and you're going to have less total losses. They tend to be very consistent doubles and triples, and in general we average high teens overall percents. So from an annualized return basis, between roughly 16 and 20%.
Okay, yeah, which is great. Like obviously, 20% over 5 years. I think at 20%, it's hard to do compounding math in your head, but you double every 3.5 years or something like that.
And that term there that I was given, that's an unweighted average annual return. So,
okay.
In that scenario, exactly, yeah. So if you hit 20% over 5 years, that's a 2x multiple.
Okay, cool. All right, and so, what's your deal flow like right now? How many projects do you guys have at a time, and what's your pipeline like?
Yeah, we've grown the capabilities of our team and found some nice pockets of opportunity. But ultimately, we do about 10 projects a year. So every roughly 4 to 5 weeks, we have a new offering. In general, like I said, about 15 to 20 million per project. So the equity raise is roughly 5 to 6 million, and those typically fill up pretty quick, which is a good problem to have. But
it's changed a lot over the last 10 years. Everybody's got money. You know what I mean? 10 years ago, you had money, you could get anything you wanted. These days, everybody's got money. We're just looking for deals.
Looking for deals, right? So the pendulum always swings. It'll go back the other way eventually, but right now it's a capital-rich market to play in.
Yeah. Well, I mean, and I think this is a good point to transition to talk about the macro economy and what you see in the future, because talking about pendulums swinging, we're obviously in an inflationary environment right now. It feels crazy to me. I'm 33, and this is the highest inflation that I've seen, but I know people who were around in the 70s saw much higher inflation, 8, 10, 11%, whatever, and so this feels like nothing compared to then, I'm sure. But you can't help but think, all right, we've printed 35% of the total dollars ever printed in circulation in the last, 15, 16 months, right? And so we see that playing itself out, because residential is up 17%, year over year. At one point, I think it was up as high as 19 or 20%, and it's actually back down a little bit. Still, some parts of the country, you're seeing 25% year-over-year growth. And then, we had, annualized 5% inflation for the month of either April or May. And so, obviously, you want to be, with inflation, high inflationary environments, you want to be in assets, and that assets are real estate, and they're stocks, which are just ownership of companies. And so, do you think that we're due for a correction? Do you think that it's going to keep growing, or do you see it kind of plateauing? I mean, it seems like there's a kind of three, the only really 3 ways it can go: up, down, or the same.
Yeah, I think, from what we, and this perspective is kind of, as from our team in a consolidated voice, but ultimately, we don't see any major correction in terms of, will there be a massive decrease in price of assets? I doubt it, based on the kind of monetary policy we're seeing from the Fed, and, really they're taking a lot of steps to prevent that from happening. So, what we see is probably, maybe a year or two of above average inflation, kind of easing into that. But like you said, what is the best defense against inflation? It's to own hard assets. So even if that inflation, say, cuts a little bit into your cash flow, you're still owning an asset that's cash flowing. Even if that cash flow loses a little bit of purchasing power, I mean, it is what it is. You got to look at it from a relative basis, right? I mean, if yours is losing purchasing power, is there a place that you know that with the same amount of risk could produce better cash flow or is more inflation resistant? Chances are probably not. You know, a lot of those things kind of move together. You know, I talk about it as the sea of change. You know, the ocean moves in big gradual ways, and you know, most things kind of move in the same direction at the same time. And you know, and in general, if you're losing some purchasing power to inflation, you're probably going to make it up on the back end because your asset, the value of it, has inflated to a higher level than it might not have, or than it might have in a more normal market.
Yeah, and I agree. You know, I don't see there being a correction. I don't see it going down simply because there's too many dollars competing for limited assets, and not only that, there's just too many dollars, right? And so you can look at the price of real estate right now in residential or commercial and think, oh wow, this costs like way too much money. Or you can flip that and realize that, well, the asset has not really gone up that much in value as much as the dollar has deteriorated in value. When you look at it through that lens, it starts to make a lot more sense of why we're paying the prices that we are. So personally, I mean, I thought that we were done seeing increased real estate prices 6-7 months ago, and I was wrong because they still kept going. I thought we were going to see a plateau. So I mean, I do believe it'll plateau eventually, but I don't believe that it's going to drop. And so I think the sooner that you can get involved, the better. Even if you're paying higher rates than you think you would, or than you would have last year or 2 years ago or whatever. I mean, it's just a different market. Unfortunately, every time we print money, it does create a disparity, and the people it drives the gap with the haves and the have-nots, and that's sad and it's unfortunate. But what are you going to do about it, right? Like, unless you are the one actually changing the policy, you want to be on the right side of change, right? You want to be the asset owner for you and your family, so you can set up yourself and your future generations to have wealth, because you don't want to be on the other side of that coin.
Yeah, and it's so many people always look at price as a one-sided ratio. What I mean by that is you have the price per dollar, so that dollar is in the denominator of that fraction, right? And if a dollar inherently is always worth a dollar, then you only have to worry about your price, the real value of it changing. But to your point, even if the real value of your asset stays steady, but the value of your dollar is decreasing due to dilution, due to printing many, many, many more dollars, when your denominator drops, your overall value is going to increase. And that, I think, is what we're seeing in what is the real drive in a lot of these hard assets. It's not a true increase in additional value. I mean, a house is a house, right? I mean, but ultimately you have a weakened dollar that is pushing this inflation activity. And to your point, I don't see it correcting massively in another way, because they're not going to stop printing dollars at the rate they are. That activity, no one has indicated, at the federal level that they have any intention of curbing that activity. So you're just going to see a increasing diluted pool of the value of each dollar, because they keep introducing so many more to the market.
And it's healthy to have corrections.
No other way for it to go.
And so it's like when a hurricane comes through or a storm comes through and trims the tree branches, right? Like, we need those. We haven't had those because it looks bad politically if it happens while you're in office. So what happens? Well, we mess with the system. We create monetary policy and monetary easing, and we just kick the can down the road. And so sooner or later, somebody's going to have to pay the reaper, right? I don't want to be the guy to try and predict when that's going to happen, because everybody who's tried to predict it so far has been wrong. So you can't sit on the sidelines, you know what I mean?
Yep.
Until, the great collapse, as they like to call it. But at some point we're going to have to pay for, I think we're going to have to pay the price. But, in the meantime, we could have a long runway ahead of us, right? And so you want to be be sure that you're capitalizing on inflation. There's a saying in the investing world: don't fight the Fed. So whether or not you agree with it, they're going to do what they're going to do. They're going to keep interest rates low, and they're going to print money. And so, get out of cash and get into assets. And so, and then the other thing too, when you take on debt, debt owners are massive beneficiaries of inflationary environments and money creation, which is, and the federal government's the largest one of those. So that's one of their incentives, obviously, to print more money, is that it dilutes the debt they owe. And it's really the only way that they can pay it. But what can you do as a sophisticated investor? Well, you can take on debt, right? And you can lock in your interest rates over 10, 20, 30 years, where that interest rate is at 3%. That's much less than inflation. And so, like, your payment, your principal and interest payments aren't going to increase over that time frame, I mean, it's just another reason to, continue to invest in real estate.
100%. That was a nice synopsis there.
Well, thank you. This has been great. Yeah, I love what you guys are doing. I think you're in a really smart industry. What's a good way if people want to get in touch and maybe ask you some questions about investing? How could they reach out and contact you guys?
Yeah, I'd love to hear comments, questions, or any additional conversation about the investment side of things. You can either check out some general info on our website. That's www.magcp.com, or just shoot me a note, Neil, Neil, @magcp.com.
Cool. And I am writing those down to add to the show notes for anybody listening. Do you guys have like a minimum investment or anything like that you want to share, or no?
Yeah, in general, it's $50,000 per investment minimums. But for first-time investments, we're flexible going to half that, just to get feet wet and start hopefully a long-term relationship on that side.
Great. Well, Neil, thanks very much. This was awesome. I appreciate your time and provided a lot of value for the listeners today.
Awesome. Thanks for having me, Austin. Appreciate it.